backside. Now, what's happened over the last 4 or 5 years has been pretty epic for uranium in terms of the downside. Uranium had a terrific performance from 2001 to 2007. You had the price of uranium go from $7 per pound up to a high of $160 per pound. So you think about that kind of move and compare it to other commodities, it's really unheard of.
Welcome to the Power Market Report. I'm Albert Liu. My guest today is the CEO of Palisade Global Investments and host of the popular investment program Palisade Radio on YouTube. He is Collin Kettell, and he joins me today from Mexico. Collin, it's great to have you back on the program. How are you?
Albert, I am great. Thank you so much for having me on your show. I'm looking forward to sharing some thoughts with your audience today.
It's my pleasure, and I'll add that love your show, Palisade Radio, and especially the monthly segment, the Sprott Monthly Update with Rick Rule. It's absolutely essential viewing. This month you were talking about gold. Gold has been going kind of nuts lately, so why don't we start there and then work our way to uranium. Just a crazy month, down over 8% over the last month, down almost 15% over the last 3 months. I would be surprised if there wasn't a pullback in the bull run. I'm a little bit surprised that it's pulled back this much. Where do you stand on it?
What can I say about gold that's going to sound good to gold investors right now? It's ugly out there, and we've certainly been experiencing some of the wrath of the pullback. I had Rick Rule on just a couple days ago on our Palisade Sprott Monthly Market Update, and we talked about gold, and I would reference people if they want a really strong and good opinion to listen to Rick, so I will mirror some of the things he said that I happen to agree with. Nothing has necessarily changed in terms of the rally we ultimately expect from gold stocks. There has been a lot of technical damage that has been done in terms of the bull market rally that we saw happening. However, like Rick said, if you look back in history, you can find analogs to any sort of situation unfolding, meaning if you look back at 1991 to 2001 period, you had what seemed to be the beginning of a bull market in gold stocks. There was quite a rally. They then pulled back and stayed down for another several months before the real bull market started. Right now, gold has sold off pretty badly. Gold stocks relative to gold are performing decently well. So are we going to see gold go back to a double bottom? Quite possibly. I don't think the gold stocks are going to go quite to the low that they got to. With that being said, focus on investing in good placements and maybe wait a little bit before buying gold stocks at this point. You don't want to try to catch a falling knife, and we've experienced that just in the last 2 days after the Fed meeting. It's been horrific selling.
Absolutely, and although nothing has changed with respect to gold, things that sort of surround gold and make the case for gold have changed. Interest rates are changing. Fiscal stimulus would introduce yet another factor. In my opinion, take technicals aside, I think the fundamentals for gold just keep getting stronger, just because if you look at the government budgets and whatnot, they just keep digging the hole deeper and deeper. So I remain bullish on gold, even though it's given back the majority of the gains we enjoyed in 2016. Now, you mentioned that the gold stocks have performed, I guess, better by comparison. GDX is down 13% is what I'm seeing for the last month. Still up about 40% for the year. So it's been a good year, and it didn't give back nearly as much as the gold did, the metal. Do you have an explanation for that?
I do not. I would parrot what you have to say about the outlook for gold. Anything that made gold an attractive investment before January of 2016 is still in place, and maybe more so. The dollar seems to be what's driving the price of gold down, and we've seen this happen over the last few months, even going back the last year. Anytime that the dollar rallies, gold sometimes holds on, but it never beats the dollar. So you're seeing right now the dollar's at a 14-year high, and it's inevitable that gold is not going to be at a high in dollars. If you look at other currencies, it's holding up okay. The gold stocks, my feeling on why they haven't pulled back relatively as hard as gold is because gold stocks got way oversold. And back in January of 2016, as I think we discussed maybe on a previous show, gold stocks had reached a level that we were claiming was the lowest in the last 100 years. And that bear market was truly epic. And therefore, investors might be assuming via buying the gold stocks that gold is still going to move up in the next few years. And the anticipation of that is shown in the gold shares performing better than the price of gold. Rick also said to me on the show 2 days ago that gold stocks might catch up and decline just back to where they were and follow the price of gold. We don't know what we don't know until we look in hindsight, truly.
Right, and I've been kind of grappling for, searching for explanations for this. One can only guess, but on the surface, it seems to be that maybe people who invest in gold stocks are kind of looking more long-term and acting a little bit more responsibly than people who are investing in the metal, meaning people who are investing in the metal are looking at gold relative to other equities, perhaps sensing a shift in the business cycle and just jumping ship. Kind of in a reflexive action, whereas people who are buying equities, at least the people who are still in there, are thinking gold equities. What I mean is they're looking for this gold price to rebound in their time horizon, which usually tends to be quite short, but in this case, perhaps it's longer than the people who are running for the exits in the spot gold market.
Certainly true. I think that the initial buyers that come into the bottom of any bull market, the buyers that would have driven gold stocks out of the low back in December and January of 2016, would have been people that have been paying close attention to gold for some time, and they're very serious investors. And so therefore, as opposed to the top of a bull market like we might have had back in 2011, where there's what they call dumb money, people chasing prices higher, those people are a lot more likely to sell off when a shakeout happens. Whereas right now, people like myself who really believe in the narrative, people like yourself and your listeners, are probably saying this isn't something that we're enjoying right now, and the capital loss is very destructive. But because we think gold ultimately would go up, there's no point in selling after we've just taken a 30 or 40% haircut. So I would agree with you.
Okay, let's shift gears to uranium, because your company just released a research note on uranium. I have next to no experience there, Collin, but what I can tell you is that over the years, many smart people have come to me with very good reasons to buy uranium, yet the stocks and the metal, and the commodity continue to trade sideways. In fact, now going down. So talk to me a little bit about this investment in general. What is it that's so attractive about uranium? Why would you want to get in the way of something like this, especially this downtrend?
I could probably speak to uranium for a couple hours with deep passion. I have a lot of past experience with uranium, as do many of the speculators that are known in the business. Guys like Doug Casey, Rick Rule, Marin Katusa, they talk about uranium because they've had so much success with it in the past. Uranium is a very, very peculiar commodity. Most commodities have price sensitivities associated to them. So for example, if you are an oil power plant that's burning off of natural gas or off of oil, you're very sensitive to the price of oil per barrel going up double, because then the energy output's going to cost twice as much and competition's going to undercut you. In the case of nuclear fuel, uranium, what it's used for is to power nuclear power plants. And the cost of the nuclear fuel that goes into the power plant is only about 2 to 3% of the operating costs of that plant. What that means is if the spot price of uranium doubles, triples, quadruples, it's not going to necessarily play into the demand issue. What happens is if a utility or a nuclear power plant needs uranium, they're essentially willing to pay any price necessary to get it, and it's not going to have a big result on the backside. Now, what's happened over the last 4 or 5 years has been pretty epic for uranium in terms of the downside. Uranium had a terrific performance from 2001 to 2007. You had the price of uranium go from $7 per pound up to a high of $160 per pound. So you think about that kind of move and compare it to other commodities, it's really unheard of. Then it pulled back. It started to move back up again after 2008, only to be hit with the Fukushima crisis, which caused a lot of concern. There was shutdowns in Japan, shutdowns in Germany. Other nuclear power plants were put on hold, and so the supply started to pick up, the spot price of uranium dropped. Where things got real interesting, Albert, is that in January of this year, gold and many other commodities started to take off. Yet uranium, which started the year around $32 per pound, as of 2 weeks ago was as low as $18 per pound, which is pretty perplexing because uranium usually tracks the Bloomberg Commodity Index, meaning it usually falls in line with other commodities. So you had a situation where the price got really cheap, the associated stocks got really cheap, yet following Fukushima, Japan started restarting reactors. China has gone full steam ahead, as they typically do. They need power, they need clean energy that only comes from nuclear fuel. And you have countries in Africa and the Middle East that are starting to turn to nuclear power. So looking out over the next 5 or 10 years, there's a clear need for more fuel, and the only way to get to that is higher prices.
If we go back to 2007, Collin, you could just help me understand this. Is the demand for uranium fairly constant in the absence of, a literal meltdown, catastrophe? Is it generally pretty constant? And if so, how would you account for the tremendous run-up in prices around that time?
It is very constant demand. Trying to explain the intricacies of how uranium got as low as $7 per pound and then went as high as 170 is probably, as Rick would say, above my pay grade. The reason that uranium gets so oversold in the bottom, we can use the most recent example, is that there was an oversupply of nuclear fuel because Japan shut down, Germany shut down, and so the perception that a certain amount of fuel was needed was flooded by the amount of fuel that was already sitting above the ground on the surface. What's driving the price of uranium to go back up now could simply be the perception that all of a sudden the new nuclear reactors coming online are going to require more fuel. It could also be that the fuel on the surface is starting to run out. Those are very opaque issues that a person like you and me and even the CEO of a uranium company is going to have trouble getting a pulse on. So the ultimate driver of uranium, like any other commodity, is a supply-demand situation. The intricacies of that is as difficult as trying to figure out why gold goes up or down $10 within a minute.
Okay, when you say the reason uranium is going up now, is that what we're actually seeing? It's not easy to get a price on the commodity. It looked like it was in a downward trend, at least to the beginning of the month. Are you working off more recent price data? What are you seeing?
Yeah, so this is very interesting. In the beginning of November, the largest institutional stocks started to move in uranium. So when I say institutional stocks, there are only a handful of uranium companies either producing or in development that are big enough to attract an institution to come in and buy when they want exposure. Companies like Cameco is the biggest one. Then you've got Denison Mines, Fission Uranium, Uranium Resources, NextGen Uranium Energy, to name a few. I started looking at those last week or 2 weeks ago and noticed that most of them had made a bottom between November 5th and November 12th. That by itself did not mean much because sometimes these companies will move up for a couple months and then they'll move back down. What really caught my attention is a company named Uranium Participation Corp, and that's run by a fellow named David Cates that we're having on our show this week. Uranium Participation Corp seeks to allow investors to have direct exposure to yellow-cake uranium, U3O8. The way they do that is they buy uranium, they store it, and then they ultimately try to sell it at a higher price. In the past, when Uranium Participation Corp trades at a premium to the listed spot price, the spot price that you are referring to, which was at $18 2 weeks ago, it means that the investment community is getting bullish. And oftentimes what happens after that is the spot price itself moves. 2 weeks ago, Uranium Participation Corp stopped trading at a discount and began trading at a 7% premium to spot price. And the very next day, we called a bottom in uranium stocks and in the uranium spot price.
Okay, so is part of the problem here, the part of the discrepancy is that we don't get regular updates on the spot price of uranium, and you're anticipating that the next update is going to show a pretty significant uptick?
Correct. So a typical investor like yourself or myself will have access to a weekly posting of the uranium price. That is the spot price. It's only posted once a week. If you want to pay a certain dollar amount, you can get access to it on a daily basis, and I have people that I know that are getting access to this data. What's happened since we made that call about a week and a half ago is the uranium spot price bounced from about $18 up to a high of 22. So you had about a 25% move in the spot price, which is astounding if you think about it. Now, the prices got so depressed, having dropped from $32 to a low of 18 in the last 10 to 12 months, that what one would expect is a V-shaped recovery. How long that will last, meaning is the price going to snap to 22, 25, 30 before it slows down? I don't know. But what we've seen over the last 2 weeks is very clearly a V-shaped recovery, and we'll have to see how long that sustains.
Okay, now your research team sent me over a couple of plots. I just want to throw them up, have you walk us through them. The first one is the inflation-adjusted uranium price history. And it looks like you have, the significant bull market period shaded in green. This is going all the way back to the 1930s, I think. So can you talk a little bit about this?
Correct. So what we've done is we've plotted the uranium spot price and adjusted it for inflation so that you can get a better example, something that's not quite as skewed, of what's actually happened over the last 80, 90 years. There have been three major bull markets. The last one really catapulted in 2007, where we hit $160 per pound. That does not quite show on the chart. It tops out at about 90 on the chart because it's annualized, meaning that the peaks don't necessarily show through. But what you can see is that last bull market has given way to a very precipitous decline in the spot price of uranium, where we're now hovering near the inflation-adjusted lows. And so what that means is it actually doesn't provide much of an indicator of anything except to give a relative basis of how cheap the price of uranium is right now to the past. And what you'll see from that chart is that it looks quite cheap. As a contrarian investor, we like to buy things that are cheap as long as they have a reason to turn around.
Right, and the next chart, we look at the Bloomberg Commodity Index versus uranium. There's the divergence right at the end there, somewhere around December 2015. You see the lines diverging. What should we pay attention to here?
Once again, we try to look for patterns, and what we found here is that the Bloomberg Commodity Index, which tracks a basket of industrial commodities, typically trades in unison with the spot price of uranium. As you can see, about a year ago, there was a slight divergence. I don't have it in front of me, but I think you'll see one about a year ago. That quickly closed the gap. When we put this chart out, the gap had widened quite a bit, which was up until 2 weeks ago, and we said, this is very interesting price action. Typically, uranium follows the spot price of many other commodities, and it had clearly diverged. So we would expect for the historical norm to come back into play, which would be for uranium to catch up to these other commodities that have been on the move. Okay, and finally, the last plot is what we were just talking about earlier in this conversation, that is watching the stock price of uranium participation and looking to that as a leading indicator of what spot uranium is going to do. Right, so as I explained, the chart we saw a week and a half ago and put out would have just shown that Uranium Participation Corp had pulled ahead. We've taken the most recent data where the spot price has actually jumped up to $22. And now you can see that in the most recent iteration, which you'll show here on your show, is that the uranium price has caught up to uranium participation. So our expectation of that bullish divergence between the price of uranium participation and spot price is now seemingly starting to close. And one thing to look at as we move forward is, will uranium participation continue to trade at a premium, which would mean that investors anticipate the price of the spot price of uranium continuing to get higher and higher.
Okay, now here you've essentially made a technical case for uranium. What about the fundamentals? Do you see the fundamentals as staying the same? Or like gold, do you see that as time drags on and the price is low, that the fundamentals are going to get stronger?
Sure, Albert, there are quite a few people to have on your show that would be able to talk even better than I can about this, but speaking to experts like David Cates, who we've had on our show, he has a very strong pulse on the market. And we talked about the demand for uranium globally right now being at about 195 million pounds a year. That's how much yellow cake is needed to feed the reactors that give electricity globally. That is going to be increasing. By 2025, I believe we're supposed to see about a 15% increase, so you're talking about 230 million pounds needed. The amount of fuel needed to make up for that extra 30 million pounds is not going to come from nowhere. It needs to come from a mine. And this is interesting in that a uranium mine takes about 10 years to get into production from the point of planning towards production. It's not the easiest material to mill. There are heavy regulations because this can be used as nuclear fuel if it's handled incorrectly. So what's going to happen, and another reason, going back to your question of why the price can swing so violently, if all of a sudden utilities want spot price, and remember, they don't necessarily care how much they pay, they're going to jump at it one after the other to pay a higher and higher price. And it's going to take several years for the production to actually catch up to the demand. Until that happens, you could see a very elevated price of uranium.
Okay, so we're somewhere between $18 and $22 right now. Are you guys putting a forecast out?
I'm always scared to put a price forecast out, so I'm not going to give any type of exact timing. David Cates had indicated that the global cost of production is about $40 to $45 a pound right now, and that's with all-in sustaining costs for a mine. Now, because it's $45 a pound, $45 a pound uranium will not trigger banks to lend money to mines, very risky operations to build new mines, meaning we're probably going to realistically need $60 or $70 per pound for a sustained period before enough new mines can come online to start to feed that discrepancy in supply and demand. I would not be surprised to see uranium hit $160 again. I know people are going to say that's a crazy thing to expect, some commodity moving 10 times, but look, it's happened in the past, and I wouldn't expect it to sustain there, but who's to say it won't reach 100 or 200? There's little difference between that type of a move, and nobody really knows.
Okay, and then I noticed that your firm is putting money to work in this sector, or will be in the coming year.
Right. During 2016, while we were mired in one of the worst bear markets in uranium, we deployed about $1 million into companies in the uranium space. And last week, we made an announcement that we would be putting an additional $2.5 million into the uranium space by the end of 2017. So we're putting our money where our mouth is. That obviously means that we expect these uranium stocks to have a tremendous move. And maybe one other thing to touch on is, as volatile as the spot price of uranium historically has been, the uranium stocks are my most favorite sector of the mining market. As you know, Albert, the mining stocks are the most volatile market publicly traded, and as a subsector of that, uranium, may be beat by rare earths, is by far the most volatile sector. And so what you'll see is, if you pull up a chart of uranium resources, for example, or URG, or even Denison Mines, these stocks are at 1/30th the price they were in 2017, and those are big companies. So if you move down to a junior level company like Western Uranium or Forum Uranium or Kanalaska Uranium, you're talking about companies that could witness 100 or 200x moves over the next few years. As one more point to that, the CEO of Western Uranium, a company that we're very interested in, his name is George Glazer, and he is a legend in the uranium business. When he was the CEO of Energy Fuels in 2006, that stock moved 45x within 1 year. The stock price appreciated 45 times, absolutely destroying any other company on the Canadian market that year. And those kind of gains can only be afforded in the uranium sector.
Okay, very good, Collin. I want to thank you for coming on. And then if anyone wants to take a look at this research report, where can they go to find it?
Sure. Palisade Research can be found at palisade-research.com. We have all of our old pieces there. We've had 3 pieces come out on uranium in the last 2 weeks, and more to follow. And then palisaderadio.com is where you can find the interviews that I do. We're going to have a lot of same guests on that you have on to talk about the mining market. We're very focused on resource, gold, uranium, anything commodities. So please come and visit and sign up, and we'll send it to your inbox each and every week.
You've got Rick Rule coming back again for the second half of the interview you published this week, correct?
Correct. Rick will be back on Sunday to discuss uranium, and you'll definitely want to hear what he has to say.
All right, so check out Palisade Radio and Palisade Research. Collin, it's always a pleasure. Thank you very much, and please come back again.
Thanks so much, Albert. I appreciate it.
Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.